So I wanted to make a video on second leg traps and higher lows and lower highs, and really the way that you should be thinking about them and how it is going to help with trading. And the first thing I wanted to talk about was, if you take nothing else away from this video, this is the main point. So 90, this is something that I spent a lot of time thinking about over the past year or two, and it's something that you should spend a lot of time thinking about. And that when you get a spike like this, so a really strong bear spike, you should expect a lower high. When you get a spike like this, you should, in general, expect a lower high. So when you get this and you get the spike and then the lower high, then another spike and another lower high, that is trending behavior. When you get, obviously, there's a lot of reasons why this is trading range behavior, but when you get 2930 consecutive bull bars, strong bull bars closing reasonably near their highs, and then the market tries to get the higher low, fails, and then gets a lower low from here, that is more of trading range behavior. So this trending me, or not necessarily this it's more of trading range behavior, but the general point still stands, and that expect a lower high from this, and from this lower high, from this lower high. Oftentimes 50% pullback, right? So 50% is always going to be a reasonable magnet. But when you're getting lower highs and lower lows, especially, thinking about those lower highs after you get a strong spike down, that is going to be more trending behavior. And when you're failing to get that, it's going to end up being more trading range behavior. So if I were you, I would pause the video, whatever, turn off the video, and just take it an hour, 2 hours, 3 hours, whatever. Comb through, the past 30 trading days and just think about all the lower highs and the higher lows, and the 50% pullbacks you're going to see within those, and you're going to start to recognize a lot of those patterns pretty quickly. So the first thing that I wanted to talk about is, how would you structure a trade around this? And I had a particular example here with bar 44 that I wanted to mention. So let's say you see bars 30, 29, and 30. You think, okay, consecutive bull bars, but I'm buying the middle of a trading range. And this was pretty strong. So, or this move down at least was pretty strong, possible spike in channel. By the way, a spike in a channel, when you get the channel is just a lower high usually. If it's a bear, so you get a bear spike and then a pullback and then a bear channel. The channel high is a lower high. So you can think of it either way. I think of it as the channel high, but it's reasonable if you get a spike in channel to just think of the top of the channel as another possible lower high. But anyways, so if you bought here, you would have been buying in the middle of the trading range, so it's not a very good idea. And then, okay, you see, 2930, maybe we get a higher low. We fail to get the higher low and we get the lower low. And then we get a bull bar closing near its high on 44. Well, to me, this is trading range behavior. We have three really strong bull bars, but we're getting these lower lows. But this does not look like a strong bear trend to me, right? Strong bear trend behavior. This deeper pullback than you would normally expect. A pullback is usually more like this, a lot deeper than you'd expect, but the lower high still held. And then we got a bear surprise to the downside, which increased the chances that we were going to get some sort of bear trend here. But as I was saying, over here, we're getting the lower low and we're getting a bull bar closing near its high. We have these bull bars closing near their highs, and we had a strong bull spike on the open. To me, and the prior day was a bull trend. So to me, this is probably a trading range. So if it is a trading range, what is the biggest magnet in general on trading ranges? Well, the middle of the trading range is a magnet always. So let's talk about that. So let's say right here, this is going to be a magnet. And what do you know? The middle of the trading range is right around the open of the day, which is not a coincidence. And obviously, that's where the market essentially ended up closing, around the middle of the day and around the open of the day, because those are both magnets on trading range days. So it's not a coincidence that we reversed in the area that created the middle of the day, exactly, basically, one tick away from the open of the day. That is trading range behavior. That is algorithms doing things to create strong magnets. So you have multiple reasons why this is going to be a strong magnet, why we might test back into this area. In addition to that, you have a bull bar closing near its high. So if you were to buy above here, you're risking roughly 9 points trying to make 9 points. The math is something along those lines. So that means you would need at least a 60% chance for going here before we go here in order to buy the market. I think it's reasonable to do that and expect that we're going to get back to this area before we get to this area. I would not argue with you if you said 60% chance. I think that's true. However, some bulls, they say, yeah, well, we had just had three strong bear bars, 41, 42, 43. I don't really want to buy directly above this after these. I think we're going to pull back. And if you're in a trading range, what's a logical magnet for a pullback? It would be a 50% pullback. So what do the bulls do? They say, well, I still think it's a trading range. I still think we're going to get a second leg down from this. So instead of buying here, they'll buy around 50% pullback and put a stop below here. Now they're only risking 5 points and they're trying to make 14 points. And that's a good trade. Now, what's the trade-off with that? Is their probability is probably not quite 60%. It's probably more like 50%. But still, what would you rather take? A trade where your risk is 1 and your reward is 1 and your probability is 60%, or a trade where your risk is 5 points and your reward is 3 times that, so 3-to-1 risk reward with a 50% probability. The probabilities, I'm sure I'm a little bit off, but the general math still stands as to why traders decided to buy the 50% pullback and assumed they were going to get a 50% pullback from these three bear bars. So that is an area where you could notice that market is in trading range behavior because we're getting a lower low after consecutive bull bars. Again, we tried to get a higher low, but it just became a tight trading range, and tight trading ranges are often magnets. So you're going to at least get a couple points to the upside. And you can use that to your advantage to try and create, a trade that's logical to get to the midpoint. So again, the big thing to keep in mind is when you're getting these lower highs and you get a bear spike and a lower high, it's more of trending behavior usually. When you get, some sort of spike and then it fails to create the higher low here, and then we get a failed breakout below the low of the day, etc. And then you get a bull bar closing near its high. It's more of trading range behavior. So just think a lot about higher lows and lower highs and how those differ in trading ranges and versus in trends. So I have, again, a couple of simple examples here that I just wanted to go over. You get three strong bear bars, and you can see the market was trying to reverse. Traders knew this was most likely a minor reversal, but the thing is, if this is a trading range, then we could get, think about what I've just been saying. If this is a trading range, we could get a couple legs sideways to up, and we might get all the way up here. So that's why, we can segue that into second leg trap examples. Actually, I'm going to transition this differently than I thought I was going to. So I have this folder called Spike Traps. Spike Trap is not an Albrecht's term. It was something that I made up because I didn't understand what was going on, and I didn't understand that it's just a sell climax on the open and a reversal up. But I just called them Spike Traps because I made this folder 2.5 years ago, and I was confused at the time. So if you look, it's how here you can think, first off, on the open, 50% of all vacuum or of all moves are just vacuum tests. So you have to be thinking about the fact that even if you think this is strong, it might just be a vacuum test of something and you're going to get a sharp reversal. Another good example would be here. You get this and you think to yourself, well, how can we possibly not get a lower high from this? Well, it's the open of the day. And, in the open of the day, moves are more volatile. And you have to keep in mind, this is not as strong as it would be had it come later in the day, because on the open, 50% chance any sort of strong move is going to lead to a sharp reversal. And if you think about it, buying above bar 5 and putting a stop below here, you're risking, 12 points. But you know that if we trade up to a new high, first off, the daily range is probably going to double. And if we trade up to a new high, you have to keep in mind the fact that this is going to get a measured move, bar 1 through 4. Not necessarily to the downside, though. So if you might get a measured move of it to the upside, you're risking 10 to 12 points trying to make, 40, 50, something like that. And you're only going to, you only have to be right a very small percentage of the time, and you're probably going to be right 40% of the time. So if you think about, these possibilities on the open, we get a strong spike down, and it's not wrong to expect a lower high. However, you can see we got an attempt at a lower high, and then we ended up getting a rally, and it tested back and obviously let the traders out. This is a bull trend, but it's also a trading range in a way, in that we closed a lot of the gaps. Obviously, we have a large open gap here that stayed open, but I guess the point I'm trying to make is, if you think about the strong spike should get a lower high. That is your basic rule, right? Strong spike should get a lower high. A strong bear spike should get a lower high. A strong bull spike should get a higher low. That's your basic rule. And if you dive within that rule, you're going to find the nuances within the quote unquote, I use the word rule very loosely. It's not an actual rule. It's something to think about in the way of, there are obviously a lot of exceptions to the rule. That's part of what makes trading really hard is, you read through Al's stuff and you listen to all the rules the quote unquote rules that he has, but there are a million exceptions within the rule. The rule is rules in general, if you're in the stock market, are guidelines towards, but they, half 60% of the time, whatever, but there are obviously exceptions in special situations. And that's what takes so long about trading is learning to recognize the special situations where, in my mind, when I started trading, I would look at something like this. So even a year ago, I would look at something like this and I would say, "There's no chance I'm buying above bar five after we just got this. This is so strong." But now I look at it and I say, "Well, 50, the close of bar seven, 50% chance we've seen the high or the low of the day. So if the next bar is a bull bar, it's bar six. And even if we're in the middle of the trading range, if it's still relatively 50-50, if we're going to get a new low or a new high of the day, I'm okay with buying here, taking a 50-50 chance that we break out to the new high. And if we get that, the odds are increased of a measured move up. And if we get that, obviously your risk reward is well worth it. So you have to think about things, especially on the open risk reward. Well, risk reward is always important. The trader's equation is always, probably the number one rule, but I think, or the number one thing to think about, but I think about it a lot, especially on the open. And I think about the opening stat a lot of, by the close of bar six, 50% chance you've seen the high or the low of the day. By the close of bar, I believe 12, 70% chance. And by the close of bar 18, 90% chance, usually 80 to 90% chance, depending on the size of the day, that you've seen the high or the low of the day. And so you can use those guidelines in situations like this to create profitable traders equations. So I guess I would say that, and the other thing to keep in mind is that 50% is almost always going to be a magnet, right? So we have this sell off and we rally back up to 50% and then it continues down. We have this sell off, rallies back up to 50%, and then we get the second leg down. So if you sell something like this, you know that your risk is large. You also know that it's most likely we're going to end up getting a pullback. So if you sell the close of 17, what are the odds we're going to sell off all the way down to here before we get up here? I don't know, probably not as good as you'd like to think. And what are the odds that we're going to sell off, you're going to sell this close and we're going to sell off straight down to here? Very low. So that's why a lot of traders prefer to sell the 50% pullback and see what the leg looks like when their risk is really large. It's the same thing over here. Big bar, big risk. Traders want to sell the 50% pullback to improve their traders equation. So I think that if you're looking at it from the perspective of traders always trying to get the best possible traders equation in situations like this, where the market remains always in short and we pull back to 50%, you're going to start to recognize a lot of patterns. And so I think always keep the 50% pullback in mind. When you look at this and you think, we should probably get a lower high from that. If this is going to be some sort of trending behavior, you automatically should be looking at a 50% pullback as a possible area of resistance. And I wanted to mention one other thing in this video on second leg traps. I think second leg traps are important and they're difficult to understand. So by the way, this is going to be a shorter video, but I think of bar 11 as a second leg trap personally. We have a spike up like this, but the spike is not as strong as it appears to be, right? We have a huge tail on bar 8. We have a huge tail on bar 9, pretty disappointing. A tail on bar 7 as well. So it's not as strong. And then bar 10 to me solidifies that this is probably going to be a trading range. This is way too deep of a pullback, and it shows bulls were much more interested in buying, take a guess where, around the 50% pullback than they were in buying new highs. If you really think about it from the perspective of this, so traders, if bar 10 had been a bear bar closing near its low, a lot of bulls would have given up below bar 10 because it's a huge bull trap. So bulls, they were buying for any reason, hoping for a trend. We got disappointment 9. Some bulls exited. And if bar 10 had closed on its low, a lot of bears would have sold it as a possible bull trap. So a lot of the traders were fighting over the close of bar 10, the bulls were trying to make sure it didn't close on its low to trap the bulls in and get a measured move down. And the bears were trying to get it to close as low as possible. And then you get this bar. To me, well, it's disappointing for everybody. It's disappointing for the bears in the fact that it did not close on its low and we did not get some sort of measured move down. And it's disappointing for the bulls in the way that it, to me, solidifies a trading range. So bears know it's probably a trading range at this point, but they were hoping for a big bear trend. And the bulls know it's probably a trading range at this point, and they're about to give up on their chances of a bull trend. However, since this did not close on its low, traders look at this and they say, well, if it's a trading range, I could buy the 50% pullback. And you can see on bar 11, so traders, a lot of bulls waited for bar 10 to close. And then as bar 11 opened, traders said, okay, great, now I'll buy the 50% pullback. Now that I know this is not a big bear bar closing near its low, trapping the bulls in, a lot of bulls said, okay, now I'll buy it. And then they bought it during bar 11, and that caused the bull bar to close so strong. However, to me, you still look at this, and it's still probably a trading range. If you look at, the huge tails and the huge bar on 10, bulls did a good job reversing 11, but it's still probably a trading range. So what do you need for me to think that it's a trend? Well, I need to close a strong bull close above the new high of the day. To me, if you're buying here, it looks like you might be buying the top of a trading range and you have a big bar with big risk. So that's really not what you want to be doing. And I had I have a folder of second leg traps, and I just want to go over a couple of them. By the way, 70% so I looked through it, and there's only 3 good examples of second leg traps in this folder, 3, maybe 4. And the reason for that is a lot of the times I was making these examples, I was not as good at trading. And so a lot of them are just wrong. They're not second leg traps. And I think it's important to, go to create slides and do these things. And it's fine to be wrong. People will ask about studying methods and what's the best method to study. And I don't regret a single hour of studying I've ever done in my life on the stock market. I've studied in ways before that, I look back and I'm like, I don't know, maybe that wasn't the most efficient, but I learned things. So it's far less important how you study, and it's far more important that you study. So that to me is the big thing. What I used to do, this was my logic a couple of years ago, was when I started trading, my goal was to do it in, complete, become a profitable trader in 2 to 2.5 years. And I looked at the, how Al would say it would take 5 years. And so my logic was I would trade a practice day every day on top of the real day. So I basically would be trading, sunrise to sunset I did that for like a year. And my goal was, I figured if I could trade 2 days every day, then that would cut out, an extra 2 years of work. Because if it takes 5 years and I traded 2 days for 2.5 years, then that would cut out that work. And obviously that's not how this works. It just takes time, and that's how it is. But my point being, that was probably not my most effective method of studying, but I learned a lot from those things. So never, if you have an idea and a way you want to possibly test out studying, just do it. It's going to help you regardless. But anyways, these are examples. Some of them are second leg traps. Some of them are just examples of traps, but I still think that they all matter. Here, we're on the open. We have a tight trading range, and then we have a bull bar closing near its high on bar 10. For me, it's good that the bulls broke out of the high. However, I want good follow through. There was a bear trend coming into the prior day. It's possible we end up getting a rally, but this is a big bar with big risk, and we're trying to break out of a tight trading range. So I need good follow through. You don't get it on bar 11. So if this is your buy and you're hoping for good follow through, you're thinking really bullish, why is the market basically offering you the exact same entry price that it offered you here? It's probably not a great thing. If it's that bullish, why did nobody buy? And then the bulls who did buy, they panic out of their long, and that's what causes the huge bear bar closing near its low. It's not an example of the second leg trap thing that I was talking about, but I thought it was a good example of a trap. This is a good example of a second leg trap. Bar 9, a bull bar closing near its high. You could argue this is the first leg, and then a pullback, and then this is the second leg. So you could say second leg trap in that way. You could also say bar 6, first leg, pullback, and second leg up. And I think the big thing with second leg traps, this is in my mind. First off, they're not always one bar. They can be a lot more than one bar. Second leg traps can be 4 or 5, however many bars. But to me, for some reason, in my brain, when I see a 1 bar trap like bar 9 on this example, or bar 12 bar 11 on this example, I think of that as a second leg trap. And then if I see an example with 4 or 5 bars as a second leg trap, I think of it as a second leg and then a trap. It's not different. And I don't know why. For me, I distinguish the difference between the two. But do whatever is going to work for you in your brain, right? That's the thing about trading. It's very personal. You have to figure out what exactly methods of everything work for you. But anyways, big bull bar closing near its high. And you can see, though, we do not break out of the bar 4 high. And the price action leading up to it, consecutive doji bars, tight trading range, not all that bullish. So you have to think about here, well, possibly this is a second leg trap. If you're buying above bar 9, you have to think about what you're saying. If you're buying here, you're saying, I think, while this might have been a trading range, I think we are now in a bull trend. So if you're buying above bar 9, the only valid premise is that we are now in a bull trend. If we are in a bull trend, the market's going to go up for a very long time. And if the market is going to go up for a very long time, it's probably better to just wait and see if you get consecutive bull bars, and then your probability will go up quite a bit. So it's probably better to just wait and see if bar 10 is a big bull bar closing near its low. And it's not. You can see this. So a lot of times when you get second leg traps and then you get a bear bar closing near its low, trapping the traders in, a lot of traders can take the sell below that low for a possible swing down. Yeah, these are the examples I was talking about that I'm not even sure what I was saying. That was obviously a second leg trap, and this is too. So here's an opposite example where we got a first leg down here, and then a pullback, and then big climactic bear bar closing near its low. Again, so if you're selling below 13, your premise is that this is now a huge bear trend, and you want more follow through. So you need 14, 15 to be good bear bars closing near their lows. And why not just wait for the one more bar instead of selling here, risking a possible trap? Because if you sell here and then you get a bull bar closing near its high, you're probably going to have, you do have to exit here. And it's far better to just wait and see if you get consecutive bear bars, because then it's a lot less likely to be a trap. Because if you get consecutive bear bars and then a bull bar closing near its high, so let's say 14 looked like 13, and then 15 was 14. So 13 big bear bar closing near its low, 14 big bear bar closing near its low, and then 15 looked like 14 bull bar closing near its high. It's a lot less likely that you're trapped in if you sold below that second bear bar than it is here, where you get one giant bear bar that ends up just being a sell climax, big bar, big risk. Traders don't want to sell it. And then you get a bull bar closing near its high. And now if the bulls, they're thinking, well, if this is probably a trading range, this looks like a leg in a trading range, and this just looks like a climactic second leg trap, reversal up, bull bar closing near its high, good risk reward. You can buy taking a chance that we're going to break out to the upside of the 18 bar range. We haven't formed the 18 bar range yet, but once we do form it, if you're right and we start to rally a little bit here, if you're right and we start to rally a little bit here, by the time we get to bar 18, we'll be in the upper part of that range. And so if we are in the upper part of that range, it's reasonable to think we're going to break out to the upside, thus reasonable to buy above here, taking a chance we do break out to the upside. I think I had one more example. I did not. So I already went over the sell climaxes. I believe I went over everything I wanted to cover. So like I said, this is just going to be a shorter video, but just those are my general thoughts on second leg traps. And again, the most important concept in this video, I think, is thinking about lower highs and higher lows.